What is up? This is the Working Investor. In this video, we are going to cover everything ULTY related. How people get attracted to its fat dividend distributions. We're going to go over the debate of ULTY and try to settle it. Because honestly, I feel like there are two types of investors. There's the NAV growth-focused investor that focus only on the NAV. And then you have the yield chasers that only focus on the yield, the dividend distribution, and forget about everything else. And nobody really looks at the full picture. And we'll talk about the competition, which is like sharks in the water smelling the blood. And they're coming out with, literally, you could see the audacity of rec shares coming out with the ETF, exactly the same sounding ETF as ULTY, just ULTI instead of ULTY, calling it Rex Income Max Trademark Option Strategy ETF, launching tomorrow. By the time this video is published, it will be tomorrow. And the competition even continues on with Curve's KYLD. You know why it's called KYLD? Because after ULTY's dead, they have killed ULTY. That's why it's called KYLD. And this is the Curve High Income ETF, the ETF you have been asking for, coming out on Halloween as well, with weekly distributions from Curve. So apparently, the word on the street is people like a lot of the features of ULTY, and there are a lot of problems with ULTY that people dislike. And the competition wants to get that AUM, and they think they have a better product. As always, nothing here is financial, tax, legal advice, or any sort of advice. This is purely for fun and entertainment purposes only. Please see all my disclaimers. Let's get into the video. Guys, the YouTube space is going to be blowing up with information, disinformation, reinformation, all about ULTY. So let's start breaking this down over here. Number one, I apologize if I'm insulting your intelligence, because a lot of my viewers I'm discovering are extremely intelligent and they know basic rudimentary things. But just in case I have some newer people here, I welcome you, and we'll talk a little bit about total return. And this is the part that it's so fundamental, so understandable, but this is the part that is so misunderstood. Let's go over it. Total return has two pieces in the puzzle. Any fund that gives a distribution, you have to look at both pieces. Now there are two pieces. There is the NAV, which is the price, the net asset value, and then there is the portion called the distributions. Together, as a holistic, you have the full picture of the puzzle called the total return. There are some serious fallacies of people who only look at the NAV. And I'm telling you, there are some serious fallacies that you probably didn't even think about, that people who only focus on the distributions and don't know how to work a fund that goes down in price, which, just so you know, I don't like that kind of style, but I understand that kind of style. The first thing you have to understand is, and you have to accept, is if somebody wants to invest in ULTY, a fund that has gone down 51.63% in price, in net asset value, year over year. But if you look at the total return, you're going to see some magic that even though it's down over 50% year over year, in the total return, by adding all the dividends, they have a total return of 19.63%. So are you looking at it from the 19.63% total return? I'm going to tell you the shocking truth. Most people do not. Most people look at ULTY purely from a price total return. So when they think of ULTY, they think of this, which looks horrible. And that is your NAV-focused, growth-only investor. And I understand that team very well. But if you look at the right, the yield chasers, they're focusing on the distribution rate. They're looking at 86.56% distribution rate. Now, you know the saying that sometimes, when there's an argument, sometimes it's two people have an argument, and somewhere between the two people is the truth. And I truly believe so. I think it's not the NAV, it's not the distributions, it's the total return. that will give you the full picture. It all boils down to basic grade school arithmetic. Now, let me tell you the sad truth for the people that seem almost very immature, they'll just look for the distributions of 86.56%, right? When they get the dividend, I hear people saying, wow, I got several $1,000s of income from ULTY this week. That is a complete and utter misconception, lie, and that will get them in trouble because you did not get 86.56% annualized return. You got basically somewhere around 18, 19% total return, 1 year total return, 19.99, whatever. Sub 20% total return. That is your total return. That means maybe 23% of your distribution is money that you actually can take, and the rest you may have to reinvest. Otherwise, you're divesting to cash. Now, here's the problem, guys. This total return that you see here, I keep moving it around. It's 18 or 20, whatever it is. It's called 18%, 20, whatever, 20%, 18%. This total return that you see here, that is only if your initial capital is intact and you're not divesting to cash, aka not using the dividends. That means if you have to reinvest, let's say you have $10,000 that you put into ULTY, and you keep reinvesting as much as you can just until you get that $10,000 back in the account, and everything in excess of that you get to keep. In other words, 23% of whatever dividends you got to keep. But you have to keep reinvesting the majority, then you have the privilege of getting this, total return that you see here. But if you just take the distributions, you're divesting to cash week after week after week, and you're not going to be getting a 18 to 20% total return. You're going to be getting maybe a 10% total return, which is really subpar. So that's why I say investing in ULTY is like a part-time job, because you have to calculate every single time you get a distribution, how much do I have to reinvest? How much do I have to put aside for taxes? I know people say, oh, it's possibly ROC, but we don't know until at the end of the year when you get your 1099 div and speak to your tax advisor. But it's like a part-time job. Aren't you investing in this to have passive income and not another job? Are you trying to buy yourself another job? Look, for example, at this simple fund of EGGS. This thing is beating, we're looking at year to date because it launched towards the end of the year. It's beating ULTY year to date by almost a factor of 2. It's beating the S&P in total return. And if you look at price return, you could see in price return that EGGS is up 11.85%, and that's just on price return, while ULTY is down like a dog, 45.71%. I don't mean to offend any dog lovers, just an expression. But you could see the simplicity. You buy a fund that provides you income, right? You get to keep all the income. If you took all the income of EGGS and used it, put away for taxes, put away for whatever you wanted, you don't have to think about it. It's so simple. As a matter of fact, if you did zero reinvesting, your NAV is going up. It went up almost 12%. It's tracking very close to the S&P 500. And guess what? Chances are that if your NAV is going up, your distributions are going up, and you're getting rewarded for holding this longer and longer and longer. So you're getting peace of mind. You don't have a part-time job now figuring out how much to reinvest, and it only gets sweeter from here on out. Not financial advice, but the point I'm trying to make is high yield dividend growth investments is so much less stressful. So much peaceful. You have to also factor in not just the total return that's, subpar with ULTY based on a lot of competitors, but also the time you have to think about it and talk about it and reinvest in it. That time is a price. You don't see it in your expense ratio, but it's your time ratio that you're wasting your time having to figure out how to manage this fund to best optimize it. If you like that kind of stuff and that's your hobby, then good for you. But if you're looking for peace of mind and you're looking for funds that just reward you for being in it longer, and as the market grows, it keeps up with the market and growth, and the dividends tends to go up with time, nothing is promised, then that seems like a better fund. Eventually, the sort of high yield may become ultra high yield, but truly high yield that you actually can keep because your yield on cost will be incredible. Now, I want to go over my little note over here. So we spoke about total return. We spoke about the growth minded that they don't factor in dividends. And we spoke about the income minded, they don't factor in the NAV. I want to talk about a couple poverty of the mind. A lot of investors I speak to literally are poor in the mind. Some people think that once you ROI is far greater than total return. And this is a massive mistake. Just because something ROI, let me give you an example. Look at Misty, a very popular fund. It came out 2/22/2024. We're going to look at to date. And yes, it's incredible. 175.89% total return. They ROI'd, and that's great. And you cannot argue about that. But then if you look at MSTR, it almost tripled. It almost tripled pretty much, right? So this thing almost doubled, that thing almost tripled. So relative to the underlier, the total return is what's most important, not the ROI, because with these funds, you take the roller coaster together, right? There are 3 people on this roller coaster. 1 person's on the track, 2 people are off the track, let's say. I know it looks a little bit skewed, but you're taking the same risk of the underlier because MSTY has the same downside risk as MSTR, but it has capped on the upside. And it's okay that's a covered call fund, but if it lags a lot, it's like for the measure of risk you took, your reward is not that great. You don't want to go to a casino where you have to gamble $1,000 for a chance to win $1. That's not a fair, win to loss ratio. You want to have it reversed. You want to gamble $1. Not that you want to gamble. Shouldn't gamble, but people who like to bet on stuff would like to bet a small amount in order to be able to win a larger amount. So for the measure of risk you take, are you getting a fair squeeze, a fair reward? Look at the 1-year chart of Coney versus Coin. Coney on the 1-year chart, it says that, I can't even toggle this thing here, but it says that Coney is 12.77% total return, right? If you want to argue, you could say it's 18. I don't know if I'm doing it right. Yeah, 12.77. Coin is 58% total return. So Coin, you're taking the same risk. Look carefully at the chart. When the market goes down, they both very in lockstep go down, but you're capped on the upside. So Coin at least gives you 4 times, if not almost 5 times, the win rate of a total return, almost 5x total return, 500% total return. Is that fair to take the same risk on the downside and get such a horrible, tiny fraction of the total return on the upside? That is not fun. That is not a fair risk to reward ratio. You can argue and say, oh, wow, 12.77% per year, that's pretty good. But what kind of risk relative to the risk? If you got 12.77% in SGov, that would be amazing because that's a risk-free rate. That is insane. Everyone will be parking their money because for the risk, the measure of risk you take is so minimal. I mean, if you believe in treasury products, compared to the reward is great. But if you're getting a 12.77% reward, but look at this crazy risk you took. At some points, you're down 20%. There should at least be a pot of gold at the end of the rainbow. The question you have to ask yourself is, if the total return is about 18 to 20%, right? Why advertise and try to give you a mass yield of 86% only at the end? Do you get to keep a fraction of that? Why not, make ULTY 15% dividend and maybe 3% growth, and then your NAV is stable. Your NAV maybe went up 3% over the year, and over time, maybe it drifts up in time. You know why? Because they're looking at marketing. They're looking at what are people going to line up for. If the investor crowd is a more intelligent crowd that looks at the total return, they will cater to that crowd because they want your AUM. Unfortunately, they look at a lot of investors like we're a bunch of dumb donkeys and we don't know anything. All we see is the carrot and we don't see the stick coming right afterwards. They think that we don't see the full picture, that the distributions is only a picture, a portion of the entire picture. We have to put the NAV into consideration. And listen, I don't blame them. Don't blame the player, blame the game. People are lining up, and they have billions AUM, and that's okay. And I'm not saying it's wrong. They are, total return positive. I'm not looking just at the price distribution, but it's pretty much, it's a part-time job to work this fund. And that is why the competition knows this, and they think that they can have an enhanced product that can kick their hiney, and hence KYLD is coming out and ULTI is coming out. So we're going to go ahead and look at these funds when they come out and go into the guts of their option strategies as much as we could learn. And we'll all learn together about these funds and see if it's a right fit for us or not, and see if they actually are a good, equivalent of ULTY or a better version of them. Anyways, let me know what you guys think. This is the Working Investor Overnight. I hope you guys have a wonderful trading week. Be well.